Sell at VAH, wait for price action to show acceptance or rejection.
Got it. Confirmation is king. Now, the HVN's high-volume nodes.
The bulges. These represent solid ground, areas of past agreement and acceptance. Price often gets choppy or consolidates within HVNs because there's a lot of two-way interest there. Here's a practical tip. If you're trading a breakout away from an HVN, try to avoid placing your entry right into the next HVN. Price might stall there. Wait to see if it rejects that HVN or breaks through it decisively first.
Let the market show its hand at the HVN.
Exactly. See how it reacts before committing.
And the LVNs, low-volume nodes, the thin spots.
The vacuums. Remember, price hates a vacuum. It tends to slice through LVNs quickly because there's simply no significant volume, no support or resistance to stop it.
So good for targets, maybe? Or breakout entries?
Excellent for breakout entries through them or as target zones beyond them. But crucially, they are terrible places to put your stop loss. An LVN offers no protection. It's like putting your stop in thin air. Price will likely whip right through it.
That's a really critical point about stop placement. Okay, let's revisit that market analogy to make it stick.
Yeah, I like that one.
The POC is the busiest stall in the market square, right, where everyone gathers.
The main attraction.
The value area is the main market area itself. The walkway is where most people are browsing and trading comfortably.
The 70% zone.
High-volume nodes are like popular side stalls or cafes where people consistently linger and do business. Accepted price points.
Good analogy. Places of agreement.
And the low-volume nodes, those are the dark, empty alleyways connecting different parts of the market. People either avoid them or just hurry through them quickly.
Perfect. You don't set up shop in the alleyway, and you don't expect price to hang around there either. It's transitional space.
That really helps visualize the concepts. Can we maybe run through a quick scenario putting these interactions together?
Sure. Let's take USDJPY again. Imagine you draw an FRVP over the last 3 days of trading. Let's say the POC is at 157.80, the VAH is 158.20, VAL is 157.40. There's a big HVN cluster around 158.00 and a clear, thin LVN between 157.20 and 157.4. Price is currently trading down near 157.30.
Okay, so it's in that LVN, just below the value area low.
Right. What might happen? Well, that LVN below VAL is a rejection zone. If buyers step in here and price manages to push back above the VAL at 157.40 and hold.
It's reclaimed value.
Exactly. It's reclaimed the previous value area after testing below it and finding no sellers in that LVN. That could be high probability long entry.
And target.
Your first logical target would be the POC at 157.80. If it breaks that, maybe the HVN cluster around 158.00 or even the VAH at 158.2A. You're using the volume structure to map out the likely path of least resistance and potential stopping points.
That's moving from just reacting to price wiggles to actually anticipating based on market structure defined by volume.
That's the essence of it. Predictive analysis based on where the market has shown its hand, not just reactive guessing.
Are there common ways traders misinterpret these concepts once they start using them? Like seeing a POC and thinking, okay, guaranteed reversal.
That's a classic one. The POC is a point of high volume, yes, but it can absolutely be a point of continuation if price breaks through it and finds acceptance on the other side. It's not an automatic wall.
What else?
Ignoring context with HVNs. An HVN in the middle of a tight, boring range means something very different than an HVN that forms after a strong, impulsive trend move. Context matters. And, as we mentioned, misinterpreting LVNs. Thinking they're safe zones or support resistance. They're not. They are zones of imbalance and potential high velocity. Treat them with respect.
So for someone listening who's excited to master this, what are your top tips for practice? How do they get good at reading this diary?
Practice, practice, practice. Seriously, manually mark the POC, VAH, VAL on your charts daily. Even if you have the indicator, drawing them helps internalize it. Use TradingView's replay mode is fantastic for this. Go back in time, draw your FRVP on past ranges, and then step forward candle by candle to see how price actually interacted with those levels.
Actively test your reads.
Exactly. And journal. When price hits an LVN, what happens? When it tests the POC, how does it react? Write down your observations. Consciously identifying and analyzing these interactions is what builds true skill and intuition over time.
Fantastic advice. So let's wrap this deep dive up. We see how the fixed range volume profile really does offer that X-ray vision. It helps you read the market's diary by showing where the real participation, the real commitment has occurred, understanding POC, VAH, VAL, HVNs, LVNs. It genuinely empowers you to start thinking like the pros.
It really does. And I think the final thought to leave people with is this. The best traders aren't just clicking buttons based on signals. They strive to understand why. Why does price stop here? Why does it accelerate there? With FRVP, you move beyond just seeing the what on the chart. You start uncovering the why, the market's deeper intentions, written in the language volume.
A powerful perspective. So the challenge to you listening is to take these tools, apply them, practice reading that market diary, and see how this theory can genuinely transform into profit potential on your own charts. The story's there, waiting to be read. Welcome to the Deep Dive, everyone. This is where we cut through the complexity and get right to the core insights. Today, we're tackling a really persistent problem in Forex trading, this huge decentralized market.
Yeah.
How do you actually see where the money is flowing? How do you get that sort of X-ray view of where the big players are placing their bets? So we're going to pull back the curtain on a tool that, honestly, feels like a game changer. The Fixed Range Volume Profile. We call it FRVP. This isn't about finding some magic signal. It's about gaining a real competitive edge. It's about helping you shift your trading from, let's say, random guesswork to making truly strategic, informed moves.
That's exactly it. And it's crucial. Let's just quickly set the scene with Forex. I mean, it is massive. The world's most liquid market. We're talking over $6 trillion traded every single day. Yeah, that dwarfs stocks, futures, crypto, everything combined. And remember, you're not buying shares in a company here. You're trading currency pairs. Think EUR against the USD or the pound against the yen. You're basically speculating on which currency in the pair is going to get stronger or weaker relative to the other. But that brings us to that volume paradox you mentioned right at the start. Because Forex isn't centralized, there's no single place reporting the volume number. So what we generally rely on is something called tick volume.
Tick volume. Right. So that's not actual dollars changing hands.
No, not exactly. It's simply the count of how many times the price changed or ticked up or down within a certain period. Think of it like counting how many times a shop's door opens, not how much money each customer spent.
Okay, that's a key difference. So if it's just counting price changes, how can it possibly give us a reliable picture? Is that a trap people fall into, thinking it's real money volume?
It's a fair question, and yeah, you have to understand it's not precise capital volume. But here's the thing. Empirically, tick volume turns out to be a surprisingly effective proxy for actual volume, especially for the kind of analysis we're doing. More ticks generally mean more activity, more interest. The pitfall, like you said, is assuming every tick is equal in size. It isn't. But what it does show beautifully is areas of high activity versus low activity. And that's what volume profile taps into.
Okay, so that leads us neatly into volume profile itself. This is where things get really insightful, I think. So picture a histogram, the bar chart, but turn it on its side so it's horizontal, running alongside your price chart. Instead of showing volume plotted against time down at the bottom, it shows the amount of volume traded at each specific price level.
Exactly.
It's genuinely like having X-ray specs for the market.
Right.
You see not just where price went, but where the actual commitment, the trading activity was heaviest, where the real battles were fought.
Precisely put. And the fixed range part of FRVP. That just means you get to choose the specific period you want to analyze. You select a start point and an end point on your chart, maybe a specific trend leg or a consolidation phase.
So you're focusing the X-ray.
You got it. It's like using a microscope to zoom right in on a particular interaction between buyers and sellers within that chosen window. You see where most orders were clustered, who seemed to be winning, and crucially, where similar dynamics might play out again. And tools like TradingView make this incredibly easy to access and use.
Okay, brilliant. So to really get the most out of this, we need to nail down the key concepts, the vocabulary of volume profile. Mastering these terms is kind of the first step to really understanding what the profile is telling you, right? It's learning the language.
Absolutely fundamental. Let's break them down one by one, and not just the definition, but the so what. First up, the POC. That stands for point of control. This is simply the single price level within your selected range that had the highest traded volume.
The peak of that horizontal histogram.
Exactly. Think of it as the main battlefield, the point of maximum agreement or maybe maximum disagreement, where the most business got done. Price often gets drawn back to the POC almost like a magnet. It can act as strong support or resistance on retests. It's the fairest price in that range, according to the market participants. Okay, next is the value area, or VA. Now, this isn't just one price level, it's a range. Specifically, it's the range of prices where about 70% the bulk of the trading volume happened within your chosen fixed range.
So the core zone of activity.
Precisely. It has an upper boundary, the VAH value area high, and a lower boundary, the VAL value area low. This whole VA zone represents where the market perceived fair value during that period. It's where most participants were comfortable transacting. Then you'll see these noticeable bulges or peaks in the profile. These are high volume nodes or HVNs. These are distinct price areas, not just the single POC where a significant amount of volume was traded. HVNs signify strong acceptance of price.
Meaning price like to hang around there.
Exactly. It often consolidated or stalled there. They tend to act as reliable support or resistance levels because, well, a lot of people previously agreed to trade there. And the opposite of that, low volume nodes or LVNs. These are the really thin, shallow parts of the profile. Very little volume traded here.
The valleys between the peaks.
Correct. These indicate price rejection or market imbalance. And here's the critical takeaway. Price tends to move through LVNs very, very quickly.
Why is that?
Because there's no friction. There's little established support or resistance, few orders waiting. It's like an air pocket or a vacuum. Price gets sucked through until it hits the next area of higher volume, the next HVN or the POC.
Okay, that makes sense. So we have all these great concepts, but traders already have tons of indicators, moving averages, RSI, MCD.
Yeah.
Why should someone add volume profile, specifically FRVP, to their toolkit? What makes it different?
That's the million-dollar question, isn't it? The core difference is this. Volume profile is not a lagging indicator.
Not lagging. How so?
Well, think about most indicators. They're derived from past price action, usually using averages over a certain period. They're looking backward. Volume profile, on the other hand, is built from the actual transactions happening now or within the specific range you defined. Who bought, who sold, at what exact price level? It's based on real-time participation.
Ah, I see. So it's not calculating an average of where price was. It's showing where the activity is or was concentrated. It feels more direct.
Exactly. It cuts through the derivative nature of many indicators. Instead of trying to predict where support or resistance might form based on historical price patterns, FRVP shows you where the market has already demonstrated significant commitment, where those levels inherently are because of the volume traded there.
So it's showing actual market structure based on participation, not just price patterns.
Precisely. And when you learn to read it effectively, you unlock so much information. You start seeing these hidden support and resistance zones that aren't obvious from price alone. You identify the market's real fair value area. You can spot potential breakout points, those LVNs, or potential reversal zones near the VHV. You even start to recognize areas where maybe retail traders tend to get trapped and stopped out.
It's like reading the market's diary.
That's a great way to put it. You're reading the intentions behind the price moves.
And who uses this? Is this just a retail trader thing or?
Oh, no, far from it. Professional traders, institutional desks, hedge funds. Many sophisticated players rely heavily on volume analysis. They're often less concerned with lagging indicators and much more focused on order flow and where significant volume is being transacted.
So by learning FRVP, you're essentially starting to adopt a framework that the big players use. You begin to think like them, analyze like them.
That's the goal. It gives you a significant edge because you're aligning your analysis with where the real market moving interest lies.
Okay, this is powerful stuff, but let's add another layer. How does this interact with, say, basic market structure? Because price doesn't move randomly, right? It trends, it ranges.
Now you're talking about the power couple, as you called it earlier. Market structure plus volume profile. This is where it gets really potent.
So structure tells you the direction, volume tells you the significance of the levels.
Perfectly said. Market structure is the absolute foundation. It's a skeleton. Are we making higher highs and higher lows? That's an uptrend, lower highs and lower lows, downtrend. Or are we bouncing between fine highs and lows? That's a ranging market. You have to know this first. Are we trending or ranging? That question dictates how you interpret everything else, including the volume profile.
Right, context is key.
Always. And the magic happens when you overlay the FRVP onto that structure. Let's say the market is in an uptrend, pulls back, and forms a higher low. Now, if that higher low lines up perfectly with the value area low, the VAL, from your FRVP drawn over the last up leg, boom.
Double confirmation.
Exactly. You've got structural support meeting volume-based support. That's a high probability long setup. Or flip it. Downtrend, price rallies to make a lower high, but it stalls right at the POC, the point of control. It fails to break above it.
Suggests the sellers are still strong at that key volume level.
Precisely. Structure provides the context, volume provides the conviction at specific price points.
That's fascinating. And does the profile itself look different in, say, a sideways market?
Oh, absolutely. In a healthy uptrend, you'll often see the POC migrating higher along with price. The VAH and VAL will sort of trail price upwards. Pullbacks will tend to respect the value area, finding bids near the VAL.
And in a range.
In a ranging market, the profile often looks more symmetrical, bell-shaped. The POC tends to sit right in the middle of the range, acting as a pivot. You'll see HVNs clustering within the range boundaries. This is classic rotational behavior. And that's where strategies like buying near the VAL and selling near the VAH, anticipating the rotation back towards the POC, can work really well.
Okay, so let's talk specific zones. Using both structure and volume, how do you pinpoint, say, a strong support zone?
Right. So in an uptrend, you'd look for pullbacks towards the value area low, VAL, or a significant high volume node, HVN, below the current price. Then you watch the price action at that level. Are you seeing rejection wicks, pin bars, a bullish engulfing candle? That's your confirmation that buyers are stepping in at that structure volume confluence.
Yeah, resistance zones. Same logic, just flipped.
Exactly. In a downtrend, you'd look for rallies towards the value area high, VAH, or an HVN above price. Then you watch for signs of sellers defending that zone, bearish engulfing, double tops, pin bars rejecting the level.
What about breakouts? You mentioned the LVNs earlier.
Yes, the low volume nodes are your prime breakout territory. When price consolidates, often within a value area or around a POC, and then decisively breaks out through an LVN, that's often an explosive move.
Because there's no resistance in that LVN.
Correct. You look for strong momentum candles slicing through the LVN, ideally accompanied by an increase in tick volume, confirming the participation behind the break. And don't forget those specific candlestick patterns at these key FRVP levels. A pin bar right at the VAH or VAL is a classic reversal signal. An engulfing candle at the POC shows a strong shift in control. An inside bar near an HVN might signal building pressure before a break. Even a doji at an LVN that suggests indecision right before price likely rips through that low volume zone. They add that final layer of confirmation.
Let's maybe walk through a quick hypothetical. Say GBP/USD is trending up on the 1-hour chart.
Yeah.
You draw your FRVP from the last major swing low to the current swing high.
Okay.
Price starts to pull back, and you notice it's heading right towards the value area low, the VAL, that profile you just drew. As it hits the VAL, maybe slightly penetrates it, you see a big, strong, bullish engulfing candle form. Maybe tick volume picks up a bit.
Right, that's a classic setup.
So what does that tell you?
That tells you you've got a high probability long setup. The market respected the lower boundary of the value area. Buyers stepped in with force, the engulfing candle, confirming the structural uptrend. Your potential targets. You look towards the POC of that range, or maybe the VAH, as logical places where sellers might reappear or profit taking could occur. You're building a trade based on confluence, not just a pattern.
Brilliant. That makes it much clearer. Okay, theory is great, but people want to know, how do I actually get this on my screen? Is it complicated to set up?
Not at all, actually. Especially on platforms like TradingView, it's very straightforward. This is where you get hands-on.
Okay, walk us through it. Let's say I've got TradingView open, you're our USD, 1-hour chart. What do I click?
All right, so on the left-hand toolbar where you find your trend lines and drawing tools, click that icon. It often looks like a ruler or has geometric shapes. Scroll down that menu and you'll see an option labeled Fixed Range Volume Profile. Just click on that.
Okay, got it. Tool selected. Now what?
Now you tell it where to measure the volume. Click once on the chart where you want the analysis to start, typically a clear swing low or the beginning of a consolidation. Then just drag your mouse across to where you want the analysis to end, maybe the recent swing high or the end of that consolidation period. Click again.
And bam.
And bam. The volume profile histogram should appear vertically along the price axis for that range you just selected.
Simple enough. Any settings we need to tweak?
You can customize, right-click on the profile itself and choose settings. You can adjust the row size, which affects how granular the profile looks, change colors if you like. But the absolute most important setting, in my opinion, is a checkbox usually labeled extend lines or similar. Make sure that's checked.
Why is that so important?
Because it projects the key levels, the POC, VAH, and VAL, across your entire chart to the right. So as new price action unfolds, you can see how it interacts with those crucial historical volume levels without having to constantly redraw the profile. It keeps them relevant.
Ah, okay, that's super useful. And reading the output visually.
It's pretty intuitive once you know the terms. The longest horizontal bar, often highlighted, is your POC. The shaded area around it is the value area between VAH and VAL. And the really skinny sections are your LVNs.
Now, about choosing where to draw at the anchoring points. You mentioned swing low size, consolidation. Any best practices there?
Definitely. The key is to anchor it around a meaningful price range. A completed swing move, a significant period of sideways consolidation, maybe the range of the previous day or week. What you don't want to do is just randomly select a small, insignificant wiggle on the chart. The data won't be meaningful. Context is everything. Choose ranges that represent a distinct phase of market activity.
Makes sense. Garbage in, garbage out, basically.
Pretty much. And here's a time saver. Once you get the settings looking how you like the colors, the row size, those lines extended, save it as a template in TradingView.
Good tip, so you can apply it instantly later.
Exactly. Keeps your analysis consistent across different charts and timeframes.
Are there common pitfalls people hit when setting this up? Mistakes you see often?
Yeah, a few common ones. Like we said, anchoring it to too small or irrelevant a range that gives you noise, not signal. Forgetting to extend the POC, VAH, and VAL lines is a big one. You lose the future reference points. And sometimes people get excited and just plaster their chart with overlapping profiles everywhere. That just creates visual clutter and confusion. Less is often more.
But can you use multiple profiles strategically?
Oh, absolutely. That's actually an advanced technique. You might draw one profile over, say, the entire last week to understand the macro structure and key weekly levels. Then within that, you might draw another smaller FRVP over just less 24 hours, or a current consolidation phase to find micro-level opportunities.
Looking for confluence.
Exactly. Where does the daily POC line up with the weekly VAL? Or where does a 4-hour HVN overlap with the daily VAH? These confluence zones represent incredibly significant price levels because they matter across multiple timeframes and participant groups.
That's a great advanced concept. One last practical tip.
Combine FRVP with alerts. Most platforms let you set an alert when price crosses a specific level. Set alerts right at your VAH, VAL, and POC lines from your key profiles.
So you don't have to stare at the screen all day.
Precisely. Let the platform notify you when price reaches a critical decision point defined by volume. Then you can take a look with fresh eyes. It saves screen time and mental energy.
Love it. Okay, so we know how to set it up. Let's dive deeper now into interpreting these shapes and levels.
Yeah.
This is really about reading those footprints, right? Understanding the story the volume tells.
Exactly. This is where you translate the visual data into actionable insights. Let's revisit the POC. We know it's magnetic. But also watch how the POC migrates. If you draw sequential profiles over time, and the POC keeps moving higher in an uptrend, that confirms trend strength. Conversely, if price breaks below a significant POC and then fails to reclaim it on a retest, that can be a powerful signal that the bears have taken control at that crucial consensus point. It's dynamic, not static.
Okay, so it's not just a level, but its behavior over time matters.
Yeah.
What about the value area VAH and VAL?
Right, the 70% zone. Think of it as the accepted fair price range for that period. When price breaks out of the value area, either above VAH or below VAL, and stays out, that's a strong indication the market is rejecting the old value and seeking a new one. This often initiates strong trends.
So breakouts from the VA are significant.
Very. And within the VA, or when price returns to it, VAH often acts as initial resistance and VAL as initial support. But, and this is key, you always look for confirmation. Don't just blindly buy at VAL or sell at VAH. Wait for price action to show acceptance or rejection.
Got it. Confirmation is king. Now the HVN's high volume nodes.
The bulges. These represent solid ground, areas of past agreement and acceptance. Price often gets choppy or consolidates within HVNs because there's a lot of two-way interest there. Here's a practical tip. If you're trading a breakout away from an HVN, try to avoid placing your entry right into the next HVN. Price might stall there. Wait to see if it rejects that HVN or breaks through it decisively first.
Let the market show its hand at the HVN.
Exactly. See how it reacts before committing.
And the LVNs, low volume nodes, the thin spots.
The vacuums. Remember, price hates a vacuum. It tends to slice through LVNs quickly because there's simply no significant volume, no support or resistance to stop it.
So good for targets, maybe? Or breakout entries?
Excellent for breakout entries through them or as target zones beyond them. But crucially, they are terrible places to put your stop loss. An LVN offers no protection. It's like putting your stop in thin air. Price will likely whip right through it.
That's a really critical point about stop placement. Okay, let's revisit that market analogy to make it stick.
Yeah, I like that one.
The POC is the busiest stall in the market square, right, where everyone gathers.
The main attraction.
The value area is the main market area itself. The walkway is where most people are browsing and trading comfortably.
The 70% zone.
High volume nodes are like popular side stalls or cafes where people consistently linger and do business. Accepted price points.
Good analogy. Places of agreement.
And the low volume nodes, Those are the dark, empty alleyways connecting different parts of the market. People either avoid them or just hurry through them quickly.
Perfect. You don't set up shop in the alleyway, and you don't expect price to hang around there either. It's transitional space.
That really helps visualize the concepts. Can we maybe run through a quick scenario putting these interactions together?
Sure. Let's take USDJPY again. Imagine you draw an FRVP over the last 3 days of trading. Let's say the POC is at 157.80, the VAH is 158.20, VAL is 157.40. There's a big HVN cluster around 158.00 and a clear, thin LVN between 157.20 and 157.4. Price is currently trading down near 157.30.
Okay, so it's in that LVN, just below the value area low.
Right. What might happen? Well, that LVN below VAL is a rejection zone. If buyers step in here and price manages to push back above the VAL at 157.40 and hold.
It's reclaimed value.
Exactly. It's reclaimed the previous value area after testing below it and finding no sellers in that LVN. That could be high probability long entry.
And target.
Your first logical target would be the POC at 157.80. If it breaks that, maybe the HVN cluster around 158.00 or even the VAH at 158.2A. You're using the volume structure to map out the likely path of least resistance and potential stopping points.
That's moving from just reacting to price wiggles to actually anticipating based on market structure defined by volume.
That's the essence of it. Predictive analysis based on where the market has shown its hand, not just reactive guessing.
Are there common ways traders misinterpret these concepts once they start using them? Like seeing a POC and thinking, okay, guaranteed reversal.
That's a classic one. The POC is a point of high volume, yes, but it can absolutely be a point of continuation if price breaks through it and finds acceptance on the other side. It's not an automatic wall.
What else?
Ignoring context with HVNs. An HVN in the middle of a tight, boring range means something very different than an HVN that forms after a strong, impulsive trend move. Context matters. And, as we mentioned, misinterpreting LVNs. Thinking they're safe zones or support resistance. They're not. They are zones of imbalance and potential high velocity. Treat them with respect.
So for someone listening who's excited to master this, what are your top tips for practice? How do they get good at reading this diary?
Practice, practice, practice. Seriously, manually mark the POC, VAH, VAL on your charts daily. Even if you have the indicator, drawing them helps internalize it. Use TradingView's replay mode. It's